Hello, class, and welcome to your Chapter 2 Knowledge Check. So, you're going to start getting deeper into accounting and start learning more about how accounting systems work and how accounting transactions work. In chapter one, you started to look at some of our general purpose financial statements. So your statement of income or your income statement, your statement of retained earnings, your balance sheet, and your statement of cash flows. So we're really going to start getting into how you record transactions that eventually make it on to those financial statements. Remember the accounting equation, assets equal liabilities plus equity. However, let's look specifically at the balance sheet um, and some of those asset accounts. We talked a little bit about this for chapter one. We're going to talk a little bit more about it now. Some assets, again, assets are anything that the company owns. So, cash, that's an asset. All right. So whether it's cash on hand or cash in the bank, that is cash or an asset to the company. Accounts receivable. If someone owes the company money, typically when you sell inventory or services to someone on credit, meaning they don't pay you immediately, it's an account receivable. And that is owned by the company. And so that's an asset. A note receivable, all right, a promissory note, or if you make a loan to someone else, you would issue a note receivable. They owe you money. So you own that debt from someone. That's an asset. Prepaid accounts. If you prepay for a service, that is considered an asset until you use the service. When you start to use the actual service, then you use up the prepayment. It is no longer an asset. Supplies. If you buy supplies for your company, those are considered as assets as well. Equipment. If you operate a company that needs equipment, that would be considered an asset. Buildings and land. So the facilities that you use to operate your operations or your company, those will be considered assets. Your liabilities, accounts payable. Again, if you owe someone some money, that's a debt that you owe. That's considered a liability. A note payable. Again, if you write a promissory note to someone saying that you're going to pay them later, that is a liability. And unearned revenue. Okay, so if you record revenues for items or services that a customer pays in advance, that is considered unearned revenues. Now, when you actually deliver the goods or you deliver the service, you start to earn that revenue and then you can put it in your revenue account, which appears on your income statement. But until then, you owe that person something, right? You owe them goods or you owe them services, and they've already given you the money for goods or services that you have not yet provided. So that is a liability. And equity again are owner investments. So when an owner invests in a company, it increases both the assets and equity because let's say they invest cash in the company, your cash will go up because they're giving the company cash, and equity would go up. All right, which is usually in the form of common shares or common stock. All right, so those are some of the accounts that you will see in those specific categories: assets, liabilities, equity. Again, mentioned it in the last video, but I want to reinforce it because it's so important. Accounting works on what's called a double entry system, which means that things need to remain in balance. They need to equal. All right. That means that at least two accounts are involved, and there's always a debit and always a credit. All right. For one single transaction, you can never have two debits and the transaction's done. You've not fully recorded it. For a single transaction, you can never have two credits and you're done recording. It won't happen. You will not be in balance and you just need to record the rest of the transaction, right? So again, for every single debit, there is going to be a corresponding credit in accounting. and that's what we call a double entry system. You can have a debit and a credit to an asset account at the same time. All right. You can have a debit and a credit to a liability account at the same time, but there just always must be a debit and a credit. So, for example, if we buy a building, which is an asset, and we pay for it in cash, which is also an asset, to show that we own a building, we're going to increase our building asset account by making a debit, but we're giving up some cash. All right. So we no longer own that cash. We gave it up to get the building. So we're going to decrease that asset account. And to decrease that asset account, we're going to make a credit to that account. Okay. So you always have to make a debit and a credit, but you can make a debit and a credit to and the same category of accounts. So such as cash or buildings or whatever accounts are affected by the transaction, right? Last thing I want to talk about is your debt ratio, and your debt ratio is calculated by dividing your total liabilities by your total assets. Um, and it's important to assess a company's risk of failing to pay its debts, and the debt ratio tells you what that risk is. So companies usually finance their assets with either liabilities or equity, all right? And a company that finances a relatively large portion of its assets with liabilities is said to have higher financial leverage, all right? And higher financial leverage means greater risk because liabilities must be repaid and often require regular interest payments. So definitely want you to pay attention to your debt ratio, which is your total liabilities divided by your total assets. And that's it for chapter 2. I'll see you again for chapter 3.